Good morning and welcome to 5 Before the Bell, TheStreet.com's global market update, U.S. market preview, and all things financial and global right here. From the central London studios of Core TV, I am Martin Baccardax, London Bureau Chief here at TheStreet.com. And I'm going to take you through those 5 things you need to know before the bell today. There's lots to talk about. We're going to start with European stocks, but it is what I would say a weather-related day on all fronts, pardon the pun, but we will start with what we're seeing here in Europe. Stocks are I say deeply in the red. They're firmly in the red, although not terribly deeply, about 0.3% to the downside across the board. And really what we are seeing is U.S. dollar weakness supporting euro strength, and that is holding back gains on the major bourses. And we're seeing a similar dynamic here in the United Kingdom, where the sterling is rising against the U.S. dollar, and that's holding back export-led stocks on the FTSE 100. And as we always remind you, about 75% of FTSE 100 revenues come from outside of the United Kingdom, so they become more attractive as a result of the pound's weakness. When the pound increases, of course, it puts downward pressure on share prices. So that's the dynamic that we're seeing. Now, the euro had traded at a 2.5-year high against the U.S. dollar early this morning, has extended those gains since. Yesterday, of course, you'll remember the European Central Bank made no changes to its key policy rates and didn't really offer a bone with respect to when it is going to trim its quantitative easing program during the question and answer session that followed with President Mario Draghi, as I said he would not. However, what he did sort of intimate was that working groups are looking at the ways in which they can recalibrate the quantitative easing program, which is worth about 2.4 trillion euros or $2.75 trillion US dollars. They may have something for us in October, but like he said, they may not, and it's all going to depend on what happens with inflation. Now, because of the strength of the euro, inflation is actually likely to slow next year and the year after, and that's according to the ECB's own economists. So I do not expect there to be any change with respect to that. Therefore, the big component of whether or not the euro stays at these elevated levels is going to be the weakness of the dollar. We'll talk about that in a couple of minutes, but it really is a dollar story these days and not a euro one, and I do think people have taken their collective eye off the ball as a result of that. What we're going to do, though, is look at the U.S. implications of not only the storms, but the slowing economy as a result. But we will start with an update on what is happening with Hurricane Irma. Gratefully, the National Hurricane Center has downgraded the storm's power to a Category 4 storm. That means wind speeds up and around the 155 to 160 mile-an-hour range, a little bit slower than the 185 Category 5 storm that it was only a few hours ago. That said, its path has widened, and it will likely hit the Florida coast as a deadly storm on late Saturday evening or early Sunday morning. It will then head up the state of Florida into the Panhandle, potentially also as well into Georgia and the Carolinas. The governor of Georgia has actually issued a potential evacuation warning for areas along the Georgia coast, and we'll have to see what sort of wind speeds the storm maintains when it makes landfall in a couple of days' time. It is very troubling indeed, and the wreckage that it's wrought around the Caribbean Ocean is devastating, to put it mildly. Around 14 people have died, according to local officials, and the damage estimates right now are going to rise significantly past the $40 billion mark that we're seeing at the moment. Now, this is only in and around the Caribbean Ocean. We're not talking about the damage inside the United States. Miami, of course, has issued mandatory evacuation orders for the first time since 2005, and citizens are fleeing coastal areas around Miami-Dade and Broward counties. Actually, those evacuation orders may indeed escalate further up the Atlantic coast. And we are seeing the fact that Governor Rick Scott has canceled schools and universities and colleges for today, through the weekend, and into Monday, and perhaps potentially beyond, for the entire state. We know, of course, that most of the professional sports teams, I should amend that to say all of the professional sports teams, have canceled their competitions over the weekend, as have the big American football teams at the University of Florida and Florida State University. For European viewers, that might sound strange. For American viewers, you know exactly what I'm talking about. When UF and FSU talk about canceling games, they're not messing around. There's too much money involved, and it's too much at stake to take those decisions lightly. So that does give you an indication of how powerful, and hopefully not, but how deadly the storm might be. The National Hurricane Center is warning of life-threatening wind speeds and indeed sea swells that could rise perhaps to 10 to 15 feet around the Florida Keys. Now, at the same time, we heard of an 8.1 Richter scale earthquake off of the Pacific coast of Mexico this morning. There was a Pacific tsunami warning that was issued soon after, and reports of sea swells of up to 3.3 meters. Haven't had any data with respect to exactly what damage that may bring to the coast of Mexico and into Nicaragua and Guatemala. We can only hope that it won't be significant, but at the moment at least, certainly there is high alert with meteorological events happening all around the United States. Hurricane Harvey, of course, just receding the floodwaters in Houston. Hurricane Jose is coming up behind Irma with wind speeds that would put it in the Category 3 level, so it's going to be, and is, an historic storm season in the United States. Have to calculate the cost of that, unfortunately, even beyond human terms, and that is having implications for the U.S. economic projections, for U.S. interest rate increases, and ultimately for the value of the U.S. dollar. The U.S. dollar is now trading at its lowest level in 2.5 years on an index basis. And when I say index basis, what I mean is the dollar index is a measure of the greenback strength against a basket of 6 global currencies. It's the best way in which to gauge the strength or the weakness of the U.S. dollar on foreign exchange markets rather than looking at single pairs. And as I say, we're trading at that 2.5-year low, and we have moved below what's called a 200-day moving average for the dollar index for the first time since 2014. From a technical perspective, that is very significant indeed. U.S. Treasury bond yields for the 10-year maturity are trading at 2.03%, very close to the 2% mark that could trigger significant changes in equity valuations. So we do need to watch that with great care. Economists are talking about maybe a 0.3 percentage point clip from U.S. GDP in the third quarter as a result of the damage that has been brought by Hurricane Harvey in and around the petrochemicals area of Houston and Louisiana, and of course any potential damage or the likely potential damage that is going to come from Irma and Jose. The estimates from Texas are around 180 billion US dollars, and the estimates for damage in Florida and up the Georgia coast are likely to be the same. Early estimates are in the 140 to 160 billion range, but they could become higher. Now, as a result, what we saw last night from the Labor Department was a spike in jobless claims. The number of Americans who are seeking out unemployment benefits rose by 62,000, almost all of them from the state of Texas. I think it was just under 52,000 from that state alone, and that took the number to a 2-year high. Unfortunately, even though we are likely to see slowing economic growth and rising unemployment as a result of this, inflation is going to accelerate owing to the spike in gas prices and the fact that that's not pulling back as quickly as possible. In fact, there was a troubling rise in oil prices over the last 2 days as investors calculated the impact of Harvey on installations in the Gulf. They actually didn't think it was going to be that significant, but it turns out that the numbers are more than they anticipated, and they've trimmed a decent, about a 10 to 15% amount from U.S. daily oil production. So that's going to lift oil prices, keep gas prices elevated, and as a result accelerate inflation. So all of this comes together to change the rate path of the U.S. Federal Reserve, or at least the assumption of it, and now we are only looking at a 26% chance of a rate increase from the Fed between now and the end of the year. That's down from 36% last week and 43% in the early part of August. So you can see the implications this is having. Again, callous to talk about economic impacts when we are still trying to keep people safe and find houses for those who have lost their homes. But nonetheless, it is a grim task. I take no joy in doing it, but absolutely has to be done because the economic growth is going to create the value that will help people who are now displaced as a result of this historic storm season. Moving on to the big corporate story of the day, and that is Equifax. Unquestionably, it is a credit score company that has had a significant, in fact, historic data breach. About 143 million customers have had their data compromised as a result of the hack. It took place in May and June of this year, and it looks like it could be the largest in U.S. history. It's an astonishing story on a number of levels. The first is the fact that whilst this hack took place in May and June and into early July, and the company discovered it on the 29th of July, they're only making this broad public statement as of last night. The shares tumbled about 14% in pre-market trading, and they're still stuck down there, probably going to open at around $121 a share compared to the $142 close that we saw at the end of trading yesterday. So the delay in making the public statement from the discovery is troubling indeed. Further troubling, in fact, that it turns out there are reports that 3 senior executives at Equifax sold shares in the company only days after the breach was discovered, including the CFO, John Gamble. Now, the company, it has to be said, is adamant that the gentlemen involved in the sale of the securities did not know about the breach when they made the transaction. But it nonetheless is going to raise questions about the delay in letting people know and who knew what and when indeed they knew it. The Federal Bureau of Investigation is tracking all of these developments, probably more with respect to what is going to happen with the customers whose data has been compromised, more so than what's happening inside Equifax. But nonetheless, this is a PR disaster for an industry that's been under a lot of pressure about the strength and probity of the safety measures it has in place to make sure that customer data is kept secure, because we know the sensitivity of it and we know the damage it can bring to people on an individual basis and indeed on an economic basis. It turns out, it seems as if Social Security numbers have been compromised, driver's license details, and all sorts of other personal elements of personal data for the 143 million customers. Beyond that, about 209,000 credit card details apparently have also been stolen as a result of the breach. We saw shares of credit score companies here in the United Kingdom trade significantly lower as a result, and as I say, Equifax is likely to open about 14 or 15% to the downside. And once these details start to leak into the public eye and into the marketplace, especially given the fact that the market broadly is looking a little bit weaker, you can imagine that number may get more significant as the day commences. Wall Street is called lower, as I say, about 66 or 70 points to the downside at the moment for the Dow Jones Industrial Average is what we're looking for in terms of losses. A little bit higher, a little bit lower in percentage terms for the S&P 500 and the NASDAQ, but nonetheless, we're looking at red across the board. And as I say, a lot of it is going to be down to the recalibration of share prices as a result of this struggling U.S. dollar, which again is trading at a 2.5-year low, and simply the fact that we're probably going to have to reset economic adjustments in the United States as a result of the storm path. So everybody's going to become a storm watcher over the next couple of days, and we can only hope and pray that the human damage as a result of Irma in Florida and up the Georgia coast is going to be mitigated as much as possible, and that people are safe and dry over the next few days. And then after that, we can take on that task of looking at what it means for the U.S. economy. But nonetheless, investors are in a cautious mood this morning, and they are trimming their expectations for equity growth at least today and probably into next week as well. So we'll keep an eye on that. Come back to TheStreet.com. We're going to be covering this throughout the day and over the weekend as well. We're all going to be on watch when the storm makes landfall late Saturday night in Miami. And our thoughts and prayers are with the people of South Florida, indeed around the whole southeastern United States, Louisiana and Texas, in the wake of the storm Harvey, and of course in anticipation of the Hurricane Irma and Jose that comes up right behind it. That's it from me from Central London and Core TV. I'm Martin Baccardax, London Bureau Chief here at TheStreet.com. Thanks for watching. Stay safe, everyone, if you're down in the hurricane zone over the weekend. We're going to be thinking about you, and we'll speak to you on Monday.